The first rule of any investment is don't lose money. The second rule, remember the first rule. Those are the only rules. This advice comes from Warren Buffett, a renowned billionaire investor known for his intelligent investment choices. The underlying message in his quote offers a glimpse into the guiding principle behind Buffett's immense financial success. Buffett is celebrated for his value investing approach, wherein he actively seeks out undervalued companies and buys their stocks at a discount. This strategy allows him to minimize risks while maximizing potential profits. What sets Buffett apart is his strong aversion to losses.
So the one thing I can tell you about Berkshire, I can't predict what our earnings will be, and I can't predict what the stock will do, and we don't know. We don't know what the economy will do and all of that sort of thing. But we do know that we wake up every morning and we want to be safer in terms of your eventual investment. Not whether you make the most money or anything, but we do not want you to get a terrible result because you've decided to become our partner.
When his investments decrease in value, he doesn't resort to panic selling. Instead, he often purchases more of the stock, especially if he believes the company's fundamentals are still robust. Why? Because he contends that if a company's stock was a good buy at a higher price, it's an even better buy when discounted. While embracing Buffett's principle might seem straightforward, implementing it can be challenging. It necessitates a profound understanding of a company's value, immense patience, and the emotional resilience to weather the stock market's fluctuations. Sounds daunting, right? Fear not. This video will introduce you to 6 key investing principles from Buffett that can guide you in avoiding losses on your investment journey. Let's dive in. Principle number 1. Never lose money. Given Buffett's significant losses during the 2008 financial crisis, this investment rule might seem contradictory. However, Buffett isn't advocating for the complete avoidance of losses. He's emphasizing the importance of a cautious approach to investing. While the rule may appear unrealistic due to the unpredictable nature of investments, Buffett's core philosophy is about valuing risk management and capital preservation over chasing massive returns. It's vital to understand that Buffett's rule doesn't mean shunning all investments that carry potential losses. Instead, it urges investors to make decisions with the aim of minimizing potential setbacks. This might mean avoiding high-risk ventures or favoring businesses with solid financial health and proven business models that can weather market volatility. So before diving into an investment, ensure you've done thorough research to grasp what you're entering into. Recognize the risks and treat losses with the gravity they deserve. If you're contemplating partnering with a new brokerage, acquaint yourself with every facet of the firm. Evaluate the pros and cons of associating with them, and if a particular asset captures your attention, delve into its associated risks and growth potential. This brings us to the next point. Principle number 2, which is invest in what you know. Warren Buffett succeeds in adhering to the never lose money guideline through meticulous research and a profound understanding of his investments. Buffett's strategy involves rigorously reviewing financial reports, understanding industry trends, and analyzing the competitive landscape to accurately determine a company's true value and future prospects. This insight allows him to pinpoint the risks associated with a given investment, thereby effectively reducing the likelihood of losses. Buffett often emphasizes risk comes from not knowing what you're doing. There's a direct correlation between one's comprehension of an investment and its associated risk. Naturally, investments in companies or sectors with which an investor is familiar tend to carry lower risks than forays into unknown areas. This familiarity enables the investor to recognize warning signs, assess the sustainability of the business model, and grasp the company's competitive stance, allowing them to sidestep potentially hazardous investments. Principle number 3. Get high value at a low price. Price is what you pay. Value is what you get. This quote by Warren Buffett implies that just because something has a price tag doesn't reflect its true value. Think of it in terms of shopping. A cheap shirt isn't always a bargain, and an expensive one might be worth every penny if it endures. Buffett applies this principle when selecting companies to invest in. He searches for fairly priced businesses that possess a robust potential for future success. For example, while many companies floundered during the 2000 to 2009 financial crisis, Buffett perceived this downturn as an opportunity. He poured billions into firms like General Electric and Goldman Sachs, believing they were solid bargains. You stand to lose money if you overpay for an item that doesn't deliver commensurate value. Consider it analogous to paying exorbitant interest on credit card debt or purchasing items that see infrequent use. Conversely, Buffett's methodology centers on pinpointing excellent deals and prospects without overspending. In stock terms, this translates to purchasing shares of commendable companies when their valuations are depressed, akin to snagging high-quality items on sale. Nevertheless, executing this approach effectively necessitates a well-defined strategy. Prudent investing demands a profound comprehension of what constitutes a company's worth. It's advisable to focus on businesses that proffer enduring products or services and demonstrate buoyant earnings with room for future expansion. During the investment process, it's pivotal to maintain distinct criteria. This could involve committing funds exclusively to more established corporations or those boasting favorable earnings to price ratios and sustainable debt levels. Investing extends beyond just spotting lucrative opportunities. It's about securing them at judicious prices while insulating oneself from unforeseen market volatilities. By adhering to this strategy, you're better positioned to prosper in your investment endeavors. Principle number 4. Invest in yourself. Warren Buffett ardently advocates the concept of self-investment. He believes that nurturing one's skills and personal growth inherently increases one's value. Moreover, this type of investment isn't merely symbolic. It yields tangible and significant returns. Buffett has emphasized that the returns on investing in oneself are exceptional, declaring, "Anything you invest in yourself, you get back tenfold." A distinct advantage of this investment approach is its immunity to external threats. Unlike traditional investments, the gains from personal growth cannot be externally diminished or confiscated. As Buffett astutely notes, such growth is shielded from taxes and cannot be pilfered. Hence, investing in oneself not only bestows profound personal and professional benefits, but also represents an exceptional, secure investment avenue. Principle number 5. Learn about money. Investing in yourself should also encompass learning more about managing money. To Buffett, mitigating risks is pivotal to being a successful investor. He posits that the true risk in investment stems from a lack of knowledge. Hence, the more knowledgeable you are about a company and its industry, the safer your investment becomes. For an investor, it's imperative to understand various financial principles, tools, and metrics. This knowledge equips you to delve into financial documents such as balance sheets and income statements and evaluate a company's financial health. You'll also develop a comprehensive grasp of specific financial ratios and indicators that illuminate a company's standing in the industry. With this information, you can adeptly apply the margin of safety principle, aiming to reduce the chances of investment losses. What do I mean by the margin of safety? It refers to the difference between a company's intrinsic value and the market price of its stock. This principle centers around making investment choices that curtail risk and potential downsides. It entails acquiring assets like stocks or other financial instruments at prices substantially below their true value. Moreover, Warren Buffett consistently employs this principle as a safeguard to ensure that his investments remain profitable. He adopted this insightful approach from his mentor, Benjamin Graham. By buying stocks at prices less than their intrinsic value, investors create a financial buffer for themselves. Consequently, even if the broader stock market underperforms, they are less exposed to substantial losses. This strategy encapsulates the judicious mindset of investors like Warren Buffett. It's a savvy investment tactic underpinned by both astute risk management and the pursuit of financial growth. Principle number 6. Focus on longevity. Warren Buffett is notably patient when it comes to investing. He firmly believes that holding on to high-quality businesses over the long term is the most effective way to accumulate wealth. This conviction stems from the understanding that good companies generally appreciate in value over time despite temporary market fluctuations. Buffett's dedication to long-term investing is evident in his investment choices. When assessing potential investments, he and his partners meticulously evaluate the company's competitive edge and its capacity to sustain that advantage for an extended period. They seek businesses they believe will retain their robustness and profitability for decades. While Buffett wasn't the originator of this strategy, he has undoubtedly mastered it. For example, when Buffett acquired Berkshire Hathaway in 1964, the company was underperforming. In a candid interview, Buffett acknowledged that this decision to buy the company had been a grave error.
The dumbest stock I ever bought was, drum roll here, Berkshire Hathaway, and that may require a bit of explanation.
He dubbed it a $200 billion blunder and ranked it among his most regrettable investment choices. Even after recognizing the challenges early on, Buffett held on to the company. He persisted with it for nearly 2 decades, fueled by a determination not to abandon ship prematurely. However, after a thorough analysis of the operational costs and the company's future prospects, Buffett ultimately chose to discontinue the textile operations. Over time, Hathaway underwent a monumental transformation. It evolved from a floundering textile business into a diversified holding company that today holds an impressive value of $755 billion. Well, that brings us to the end of the video. Thank you for watching and staying with me till the end. If you have any comments or thoughts you would like to share, please do so in the comment section below. Until next time, have a great day.